On July 7, 2026, something happened in the gold market that the Western financial press covered as a minor footnote and then moved on. The Chinese government activated a physical delivery connection between Hong Kong and Shanghai, allowing gold to flow bidirectionally between the two markets for the first time under a unified clearing system. The governor of the People's Bank of China stood alongside Hong Kong's chief executive at the announcement. This was not a business association press release. This was a sovereign policy announcement at the highest institutional level. But here's the part nobody connected. On COMEX, the American futures exchange that has priced gold for the world for decades, physical settlement averages less than half of 1% of daily trading volume. For every 1,000 ounces that change hands on paper, roughly 5 ounces actually move. The new Hong Kong system was designed around a completely different principle. Every contract must be backed 100% by physical metal held in vault. No fractional issuance, no contract written for metal that does not already exist in storage. Settlement in physical bullion is not an option, it is the default. And for silver, as of May 22, 2026, Singapore launched a new physically deliverable silver futures contract requiring 99.99% pure bars. Not 99.9% like COMEX, 99.99%. The extra decimal point is not cosmetic. It is the difference between metal a factory can use on arrival and metal that needs to be refined again before a production line can touch it. A pricing monopoly does not die with a confrontation. It dies with a purchase order, and those purchase orders are now being placed somewhere else. Before we go any deeper, here's the question I want you to answer in the comments right now. Do you think the reference price for gold is going to come out of Asia within the next 10 years? Yes, no, or maybe one word. Drop it below. This is not a rhetorical question. This is the most consequential debate in precious metals markets right now, and I want to know where this community stands. If this kind of breakdown is why you are here, subscribe. Hit the like button. This channel covers the mechanics behind the headlines, not the headlines themselves. Let's go. Part 1. The number that stops the argument before it begins. Let's start with the data because data is the only thing that cuts through the noise on a subject this politically charged. On COMEX, physical settlement averages around half of 1% of daily trading volume. For every 1,000 ounces that change hands on paper, roughly 5 ounces actually move. In London, on the LBMA over-the-counter market, estimates put physical backing at around 1%. Analysts have argued for years that the ratio of paper claims to real metal there sits somewhere near 100 to 1. Now here is the number the new Hong Kong system was designed around: 100% physical backing. Every contract backed by real metal in a vault. Every contract traded under this framework must be backed 100% by physical metal held in vault. There is no fractional issuance, and no contract can be written for metal that does not already exist in storage. Settlement in physical bullion is the default outcome, not an optional alternative as it is on COMEX. 100% against 0.5%. That is the gap. I want to be precise about what this comparison means because precision matters here. The COMEX number is a measured figure. The Hong Kong 100% backing is a design specification, an architectural commitment built into the exchange's structure from the ground up. These are not two versions of the same product. They are two fundamentally different things that happen to share a name. The Western gold market was built to avoid delivery. And it was built that way deliberately, rationally, and for good reason. The people using it for decades were financiers. A mining company hedging next year's production does not need to move a bar. A fund taking a position and exiting it in hours does not need to move a bar. For that job, physical delivery is not just unnecessary, it is friction. Metal is heavy, vaults are expensive, trucks are slow. The system was engineered quite deliberately to let enormous quantities of risk change hands without a single bar ever moving. And for decades, that worked perfectly for the people it was designed to serve. But the world changed underneath that design. And the new market that is building itself in Asia is not competing on ideology. It is competing on utility. Part 2. The spec sheet that changes everything. Let me explain why a single decimal point in a bar specification is one of the most important sentences in precious metals markets right now. And I want you to stay with this because it sounds technical on the surface and it is anything but. The standard silver bar deliverable on COMEX is 39s fine, 99.9% pure. On May 22, 2026, the ABAX exchange in Singapore launched the Silver Singapore SSP futures contract. Its standard bar is 49s fine with 99.99% pure. That extra 9 sounds trivial. It is not. High-end solar cells and advanced electronics require 99.99 silver. If a manufacturer takes delivery of a 99.9% bar from a Western exchange, that bar cannot go straight into production. It has to be refined again. That costs money, it costs time, and it means the metal you just bought is not actually the metal you need. Now think about what that means commercially. 2 contracts on 2 different exchanges, both priced in US dollars, both for silver, but one delivers factory-ready metal and the other delivers metal that requires additional processing before a production line can touch it. When two products are priced identically, but one requires extra work before you can use it, the market does not stay confused for long. A procurement manager looks at two contracts, signs the one that saves money. That decision gets made thousands of times, quietly in offices nobody films. That is how a pricing monopoly actually erodes, not with a confrontation, with a purchase order. ABAX Exchange launched its Silver Singapore Futures contract on May 22nd, putting a physically deliverable USD-denominated silver instrument into the hands of Asian traders for the first time through a regulated Singapore venue. China imported a record 836 tons of silver in March 2026 alone, underscoring the robust activity in photovoltaic production and electronics assembly. 836 tons of silver imported by China in a single month, March 2026. That is the physical industrial demand driving this market. And that buyer, the procurement manager running a solar factory or an EV battery plant, does not need exposure to silver's price. They need bars, specific bars, factory-ready bars, delivered to a specific loading dock on a specific Tuesday. The Western market was built for the first type of participant. Asia's new infrastructure is being built for the second. If you are still thinking of this as an East versus West story, a political narrative about rising and falling empires, I want to suggest a different frame, because what is actually happening here is more boring and more dangerous than that. What is happening is a spec sheet, a boring, technical document sitting in a catalog, and it is doing more damage to the Western pricing monopoly than any political announcement ever could, because you cannot sanction a spec sheet. You cannot argue with a purchase order. Part 3. Hong Kong. The gold market that went live in July. Let me walk you through exactly what was built, because the architecture of this system is the reason it matters. The Hong Kong-Shanghai Gold Exchange Gateway is a cross-border gold trading and settlement framework connecting Hong Kong's OTC precious metals market with China's domestic Shanghai Gold Exchange. International investors can trade yuan-denominated physically deliverable gold contracts and settle in offshore renminbi without accessing mainland China's regulated markets directly. The Delivery Connect initiative, enabling two-way physical gold transfers between the HK-PMCC and the SGE International Board Vault, began trial operations on July 7, 2026. The LBMA fix is a dollar-denominated reference price operating primarily in a paper-settled environment. The HAU fix is yuan-denominated and anchored to physically deliverable contracts, meaning it reflects the actual cost of sourcing and delivering allocated bullion. That last distinction is the critical one. The LBMA gold price is derived from a paper-settled market. The HAU fix, Hong Kong's new yuan-denominated benchmark, is anchored to physical delivery. These two prices are measuring different things, and when physical demand is tight, the price derived from physical delivery obligations is structurally higher than the price derived from paper contracts that can always be rolled forward or cash settled. The government ownership structure of HK-PMCC signals institutional durability. This is not a speculative private sector project, but a piece of financial infrastructure with state-level backing from the HKSAR government, which carries meaningful implications for its long-term operational continuity. Hong Kong's stated ambition is to expand gold storage capacity to 2,000 tons within 3 years of the PMCC launch. Vault capacity is not merely a logistical detail, it is the physical foundation that distinguishes a serious bullion hub from a paper clearing mechanism. Without meaningful sovereign-scale storage, a clearing system cannot credibly offer physical settlement as a backstop. 2,000 tons of vault capacity. To put that in context, at current prices, 2,000 tons of gold is worth approximately $270 billion. This is not a startup experiment. This is infrastructure investment measured in the hundreds of billions of dollars, backed by the HKSAR government, and integrated into China's official 5-year plan. The World Gold Council's head of Asia-Pacific described the new clearing system as a major step toward becoming a price setter for precious metals. That is not a commentator on a channel like this one. That is the industry's own body, saying clearly and publicly what this system was built to do. Part 4. The silver side of this story is even more urgent. The gold story in Hong Kong is structural and multi-year. The silver story is happening right now, with more immediate physical pressure. China's Ministry of Commerce implemented silver export restrictions from January 1, 2026, mandating exporters to secure government licenses. The policy seeks to prioritize domestic supply amid rising industrial demand and global deficits. China has released a list of only 44 companies approved to export silver under the new measures in 2026 and 2027. The new rules also restrict exports of tungsten and antimony. The state-run Securities Times cited an unnamed industry insider who said the new policy formally elevates silver from an ordinary commodity to a strategic material, placing its export controls on the same regulatory footing as rare earths. China controls approximately 60 to 70% of globally refined silver. Not 60 to 70% of the mining, 60 to 70% of the refining. China mines roughly 13% of global silver output, but processes the majority of the world's silver through its refinery infrastructure, and that refinery infrastructure is now being pointed inward. China imported a record 836 tons of silver in March 2026 alone. China is both the world's largest processor of silver and is now a net importer of it. When you put those two facts side by side, they say something genuinely significant. The largest processor of silver on the planet is no longer sending it out. It is pulling more in. The export controls have a direct consequence for the paper market. Every ounce of silver that enters China's refinery system and does not come back out is an ounce that never touches the mechanism the West uses to price silver. The exchange still publishes a price, it just governs less and less of the actual metal with every passing month. The COMEX silver paper-to-physical ratio currently sits at approximately 7.5 times, with more than 7 paper ounces existing for every real ounce available to deliver. The ratio has held below the 15% stress threshold for 6 consecutive months. A single week in January 2026 erased 26% of the entire deliverable pool. The physical infrastructure of the silver market is tighter than it has been in years. 26% of COMEX's entire deliverable silver inventory gone in a single week. The paper market managed it. It always manages it until the day it does not. And the question of when that day arrives has become materially more relevant since China closed 60 to 70% of the global silver refining pipeline to outbound flow. Here is the part that most coverage of this story misses completely: the India dimension. You may have seen headlines earlier this year about India's silver imports collapsing, and that headline was used as evidence that silver demand was dying. Let me show you what actually happened, because it is the exact opposite. Part 5. India. What the headline got backwards. India historically drew around 60% of its silver through the United Kingdom. That share has been falling as imports shift toward the United Arab Emirates under a trade agreement that phases the tariff on those imports down to zero over the next several years. The demand did not disappear. The route changed. It changed away from London. And it changed contractually, not because of market mood, but because of a signed trade agreement with a multi-year implementation schedule. Effective April 2026, Reserve Bank of India regulations formally permit physical silver to serve as collateral for both bank and non-bank lending, establishing what appears to be the first time a major modern economy has institutionalized silver within a monetary collateral framework. Read that carefully. India, a country of 1.4 billion people with one of the world's deepest cultural relationships with silver, has formally incorporated physical silver into its banking system as eligible collateral. This is not investment demand, this is monetary infrastructure. The demand rerouting away from London, combined with India's domestic silver monetization framework, means the LBMA's claim to be the center of global silver pricing is being contested simultaneously from two directions: institutional demand routing away from London, and physical demand being absorbed into formal monetary systems rather than circulating through Western exchanges. Meanwhile, central banks have been accelerating a parallel trend in gold. European nations, India, and several other countries have repatriated gold from American and British custody. The stated reasons are consistent across all of them: sanctions risk, geopolitical uncertainty, and guaranteed sovereign access. The proportion of surveyed central banks storing gold at the Bank of England has fallen from around 64% to 57%. Holdings at the New York Federal Reserve have also slipped. When central banks take their gold home, they are not making an investment decision, they are making a custody decision, and a custody decision reflects a belief about the durability and trustworthiness of the existing system. These are institutions that manage the reserves of entire nations. They move slowly, and they do not move without reason. Part 6. What this means for every investor watching right now. Let me be honest about what I am not saying and what I am saying. I'm not saying the dollar collapses next year. I'm not saying COMEX shuts down. I'm not saying the BRICS launch a gold-backed currency that replaces the dollar overnight. The version of this story that promises those dramatic events on a specific timeline is not a thesis. It is a narrative, and it is wrong. What is actually happening is slower and more dangerous precisely because it is slow. Institutional power does not collapse, it erodes. Every year, a slightly larger share of the world's physical metal is priced somewhere that is not New York or London. And one morning, years from now, everyone wakes up and notices the reference price on their screen is coming from a different time zone. The mechanism behind this erosion is not political. It is commercial. It is the procurement manager signing the Singapore contract because it delivers factory-ready bars. It is the manufacturing plant that stops consulting the COMEX price for silver because the price that matters to them is the one quoted at the exchange that delivers the bars they actually need. It is the central bank that repatriates its gold not because of ideology, but because it wants sovereign access to its own reserves without depending on a foreign jurisdiction. None of those individual decisions makes a headline. All of them together are rewriting the architecture of the global precious metals market. For anyone holding physical gold or silver, the direction implied by this architecture shift is clear. A market where prices are set by delivery obligations rather than paper positions is structurally a market that trades higher. Because in that market, a shortage cannot be papered over, it has to be paid for. The structural conditions that have suppressed gold and silver pricing for decades, the ability to create and trade paper contracts far in excess of physical inventory, the ability to substitute cash settlement for physical delivery, the ability to set a global benchmark price through a market where delivery is a rounding error. Those conditions are being contested for the first time in a generation by commercially motivated buyers who have genuine physical need for the metal and are now being served by infrastructure that reflects that need. The timeline for this shift is measured in years, not months, but the infrastructure is already built and operating. July 7, 2026 was not a press release. It was a live delivery connection between Hong Kong and Shanghai activating in real time. And for gold and silver investors, the most important insight from all of this is structural. When physical demand increasingly sets the price rather than paper positioning, the price floor for both metals becomes harder. Not because of speculation, because of commercial necessity. Let me close with the things that would prove this thesis wrong, because any framework that cannot be falsified is not worth trusting. If the Hong Kong system's physical backing commitment turns out to be a design goal that is never properly audited or enforced, the central claim of this video weakens materially. Verified audits of vault holdings matter. If Singapore's SSP contract volumes stall out rather than compound, this remains a regional experiment rather than a genuine threat to COMEX's pricing role. If China loosens its silver export controls, reverting from a licensing regime back to free flow, the physical tightness argument in silver eases considerably. Those are the numbers to watch. I will report them in either direction. This is not financial advice, this is analysis. Do your own research and make your own decisions. But step back and look at the shape of what has assembled itself. A government-backed clearing system that went live in July with 100% physical backing. A silver futures contract in Singapore requiring factory-ready 99.99% bars. China controlling 60 to 70% of global silver refining and now restricting outbound flow. India formally incorporating physical silver into its banking collateral framework. Central banks repatriating gold from foreign custody across multiple continents. And an LBMA pricing mechanism that is being bypassed one purchase order at a time. The Western gold and silver market is not being defeated. It is being outcompeted. And the difference between those two things is everything, because you can survive a defeat. You cannot survive a customer leaving. This is going to keep unfolding. Every stage of it matters to anyone holding precious metals, and this is where we break it down. Thank you for watching. Subscribe if you are not already with us, and drop your answer in the comments. Does the reference price for gold come out of Asia within 10 years? Yes, no, or maybe? I read every reply, and the sharpest answers get featured in the next breakdown. See you in the next one.